Welcome to this lesson on the FINRA Series 7 exam. Today we're going to start out talking a little bit more about taxes. And I'll quiz you on that, and we'll move on to another topic before the end of the lesson. All right, so understanding the different types of taxes, classes of taxes, and what constitutes taxable income is crucial for financial professionals, especially when advising clients on tax planning and investment strategies. Taxes can be imposed at various levels: federal, state, local, and can take different forms such as income tax, payroll tax, capital gains tax, and more. Additionally, certain types of income are considered taxable, while others may be exempt or at least partially exempt. In this lesson, we will explore the primary types of taxes, their classifications, and the concept of taxable income, which is vital for both personal and business financial management. All right, so let's go through this by the type of tax. The first kind of tax I want to talk about is the income tax. Income taxes are levied on the income that individuals and businesses earn. They are imposed by the federal government. It's based on taxable income after allowable deductions and credits. The U.S. operates what's called a progressive tax system, where tax rates increase with higher income brackets. So the more you make, the higher percentage of your income you are taxed. It is also imposed by individual states, but not all states levy an income tax, so it depends on the state. Rates and brackets may vary by state, with some states using a flat tax rate, while others adopting a progressive structure similar to the federal income tax. And then some local cities or municipalities level additional income taxes on residents and workers. So this is one of the taxes, depending on where you live, where you might get hit with it on three different levels. All right, so then we also have payroll taxes. Payroll taxes are taxes that are withheld from an employee's salary by the employer to fund social programs. It's things like Social Security and Medicare. In the U.S., employers and employees both contribute to Social Security at 6.2% and Medicare at 1.45% through payroll taxes. Self-employed individuals pay both the employee and the employer portions, and when it's done this way, we just call it self-employment tax. We also have unemployment tax. So employers also pay unemployment taxes at both the federal and state levels to fund unemployment benefits for workers who lose their jobs. So that's another thing employers have to take into account. Another category of taxes we have are capital gains taxes. So capital gains taxes apply to the profit from the sale of investments or assets. We have short-term capital gains. Those are gains from the sale of assets held for 1 year or less. They're taxed at ordinary income tax rates. Then we have long-term capital gains. And those are gains from the sale of assets held for more than 1 year. And these are taxed at a lower rate, either 0, 15, or 20%, depending on the taxpayer's income. Then we have property taxes. Property taxes are imposed on real estate, and in some cases on other form of property like vehicles. These are typically imposed by local governments, counties, cities, or school districts, and are calculated based on the value of the property. They help fund public services like schools, police, and infrastructure. We also have sales taxes. So sales taxes are imposed on the sale of goods and services. These are collected by retailers at the point of sale, and then the sales tax rates can vary by state and locality. Some states also have specific taxes on certain goods, such as a specific gasoline tax or a specific alcohol tax. Another category are excise taxes. Excise taxes are indirect taxes imposed on specific goods and services, such as gasoline, tobacco, alcohol, and airline tickets. These taxes are often used to discourage the consumption of goods considered harmful, such as cigarettes, or to fund specific projects like road construction. These are the ones that are like for gasoline taxes. All right, so the final one that I want to talk about are estate and gift taxes. So estate taxes are levied on the transfer of a deceased person's estate to their heirs, while gift taxes apply to transfers of wealth made during an individual's lifetime. Federal estate tax applies to estates valued over a certain threshold, $12.92 million as of 2023, with rates up to 40%. And that individuals can give up to $17,000 per recipient annually without triggering gift taxes as of 2023. But above that, there is a tax on big gifts to other people. All right, so those are the kind of taxes. Let's talk about some of the classes of taxes, like how they function. We have progressive taxes. As we mentioned before, the U.S. is a progressive tax system. And in such a system, the tax rate increases as income increases. Higher income earners pay a larger percent of their income in taxes. So the U.S. federal income tax is the prime example of this. They have tax rates ranging from 10% to 37%, depending on your income. We also then have regressive taxes. A regressive tax system is one in which a higher burden is placed on low-income earners because the tax is a flat amount or percentage, regardless of income level. So the lower income earners end up paying a greater portion of their income. Sales taxes and excise taxes are considered regressive because they take a larger portion of income from low-income individuals, even though the tax rate is the same for everyone. We also then have proportional taxes or flat taxes. In a proportional tax system, all taxpayers pay the same percentage of their income, regardless of how much they earn. Some states, like Illinois, use a flat income tax rate where every taxpayer pays the same percentage of their income in taxes. So it does not go up, it does not go down, it just stays the same proportionally for everyone. All right, so let's talk then about the concept of taxable income versus non-taxable income. As we mentioned many times through the course, there are a lot of different kinds of categories that fall into this taxable versus non-taxable. Taxable income is the portion of an individual's or business's income that's subject to taxation after deductions, exemptions, and credits have been applied. So what falls under this? So wages and salaries are one. Those are income earned from employment, and it's fully taxable. Salaries, wages, bonuses, and tips. Interest and dividends. Interest from savings accounts, bonds, and dividends from investments are also taxable income. Capital gains, profit from the sale of investments or property, are taxable, with different tax rates applying depending on whether the gain is short-term or long-term. Retirement income, distributions from tax-deferred retirement accounts, such as traditional IRAs or 401ks, are taxed like normal income. Roth IRA distributions, if qualified, however, are tax-free. Business income, so income from a business after expenses, is considered taxable income. This includes profits earned by sole proprietors, partnerships, and corporations. Rental income received from renting a property is taxable, although expenses related to the rental can actually be deducted as much tax as you otherwise would. Unemployment compensation, so generally unemployment benefits are considered taxable income. And alimony. For divorces finalized before 2019, alimony payments are taxable to the recipient. For divorces finalized after 2018, alimony is not taxable to the recipient, nor deductible by the payer. So what are a few things that are non-taxable income? So gifts and inheritances. In most cases, gifts and inheritances are not subject to federal income tax, although they may be subject to estate or gift taxes. Life insurance proceeds. So proceeds from life insurance policies are generally not taxable. Municipal bond interest. Interest earned from municipal bonds is typically exempt from federal income tax, and sometimes from state tax if the bond is issued by the taxpayer's state of residence. That could be really nice too. Qualified Roth IRA withdrawals. So withdrawals from Roth IRAs are tax-free if certain conditions are met, including the account being open for at least 5 years and the account holder being at least 59 and a half. All right, so let's talk about a real-life scenario where we break down all these different taxes. So consider a financial advisor is helping a client named Lisa. So she's a 40-year-old professional earning about $100,000 a year. Lisa lives in a state with a 5% flat income tax and wants to understand her overall tax liabilities. So federal income tax. Lisa falls into a 24% federal tax bracket. So her taxable income above the previous bracket thresholds will be taxed at 24%. State income tax. Lisa pays a 5% flat tax on her entire taxable income to her state. Social Security and Medicare. Lisa's employer withholds 6.2% for Social Security and 1.45% for Medicare from her paycheck, and then her employer matches these amounts. Capital gains tax. So Lisa recently sold stock that she has held for 3 years and realized a $10,000 profit. Since this is a long-term capital gain, she pays 15% capital gains tax for the profit. All right, so in summary, types of taxes include income taxes, payroll taxes, capital gains taxes, property taxes, sales taxes, excise taxes, and estate gift taxes. Each tax has different rules, rates, and purposes. Progressive taxes impose higher rates on higher incomes, and regressive taxes place a larger burden on lower income individuals. And proportional flat taxes apply the same rate to all income levels. And then taxable income include wages, interest, dividends, capital gains, retirement income, and business income. Non-taxable income includes gifts, inheritances, life insurance proceeds, and qualified Roth IRA withdrawals. Which of the following taxes is typically considered a regressive tax? A, federal income tax, B, state income tax, C, property tax, or D, sales tax? The correct answer is D, sales tax. Which of the following types of income is usually non-taxable? A, wages from employment, B, interest from savings accounts, C, life insurance proceeds, or D, dividends from stocks? The answer is C, life insurance proceeds. What tax rate is generally applied to long-term capital gains? Is it A, 10%, B, 15 or 20%, depending on your income, C, 24%, or D, 37%? The correct answer is B. It's 15 or 20%, depending on your income. What type of tax is Social Security considered to be? Is it A, capital gains tax, B, an excise tax, C, a payroll tax, or D, a property tax? The correct answer is C. It's a payroll tax. What is the maximum amount an individual can give as of 2023 without incurring gift taxes? Is it A, $12,000, B, $15,000, C, $17,000, or D, $20,000? The correct answer is C, $17,000. And now a few open-ended questions. Explain the difference between a progressive tax and a regressive tax. A progressive tax system increases the tax rate as income increases, meaning the higher income earners pay a larger percent of their income in taxes. A regressive tax system imposes the same tax rate on everyone, but places a heavier burden on lower income individuals because the tax consumes a larger portion of their income. Why are long-term capital gains taxed at a lower rate than short-term capital gains? So long-term capital gains are taxed at a lower rate to encourage long-term investment in assets like stocks and real estate. Short-term capital gains are taxed as ordinary income, which discourages frequent trading and speculation. What are the tax implications of receiving a gift or inheritance? So gifts and inheritances are generally not subject to federal income tax for the recipient. However, if the value of the gift or inheritance exceeds certain thresholds, the donor or estate may be liable for gift or estate taxes. All right, how are you feeling about that? If you're doing really well, then it's time to go ahead and move on to the next topic. All right, so we're actually going to talk a little bit more about capital gains taxation. Taxes on capital gains and dividends are critical considerations for investors as they directly impact the after-tax return on investments. Both capital gains and dividends are subject to taxation, but the tax treatment differs depending on the type of asset, how long it was held, and also the investor's tax bracket. Strategies for reducing taxes on these types of income are essential for effective financial planning. In this lesson, we will explore how capital gains and dividends are taxed, discuss ways to reduce those taxes, and review tax-efficient strategies for managing investments. Capital gains occur when an investor sells an asset, such as stocks, bonds, real estate, or other investments, for more than they paid for it. The difference between the purchase price, sometimes also known as the basis or basis price, and the sale price is the capital gain, and this capital gain is subject to taxation. So short-term capital gains are gains from the sale of assets held for 1 year or less. Short-term capital gains are taxed at ordinary income tax rates, which range from 10% all the way up to 37%, the highest tax bracket. These can significantly reduce the profitability of short-term trades. Gains from the sale of assets held for more than 1 year are classified long-term capital gains. Long-term capital gains benefit from lower taxes, either 0%, 15%, or 20%, depending on the taxpayer's taxable income. The 0% rate is for single filers with taxable income up to $44,625, and married filers up to $89,250 as of 2023. The 15% rate is for single filers with taxable income between $44,626 and $492,300, and married filers between $89,251 and $553,850. The 20% rate is for single filers with a taxable income that's over $492,300, or married filers over $553,850. So you just decide where you fall in that, and then it will show you where you fall, what kind of tax rate you're going to have to pay. Capital losses. So if you have a capital gain, you can also have a capital loss. So when an asset is sold for less than its purchase price, the result is a capital loss. Capital losses can be used to offset capital gains in the same year. If losses exceed gains, up to $3,000 of excess losses can be deducted against normal income, or $1,500 for married filing separately. Losses that exceed the $3,000 limit can be carried forward to future tax years indefinitely. So if you experience some loss, that actually can offset some of your liability for your gains. Let's talk a little bit about taxes on dividends. So dividends are payments made by corporations to their shareholders, usually because of their profits. Dividends are organized into two types, qualified and non-qualified, each with a different tax treatment. So qualified dividends. Qualified dividends are dividends paid by U.S. corporations and certain foreign corporations that meet specific requirements. The holding period for the stock must also be met. Typically, the stock must be held for more than 60 days. During the first 121-day period surrounding the ex-dividend rate. Qualified individuals are taxed at long-term capital gains tax rates of 0, 15, or 20%, depending on the taxpayer's taxable income. This is a favorable tax treatment similar to long-term capital gains, encouraging investment in dividend-paying stocks. Then we have non-qualified or ordinary dividends. Non-qualified dividends are those that do not meet the criteria for qualified dividends. This typically includes dividends from certain foreign corporations and those paid on certain types of investment, like REITs, that's the real estate investment trusts. Non-qualified dividends are taxed at ordinary income tax rates, which are higher than those for non-qualified dividends. Remember, those can go up to 37%. This results in a greater tax burden for investors receiving non-qualified dividends. So what are some strategies for reducing capital gains taxes? That's something your clients are definitely going to be interested in. Holding onto investments for more than a year. So by holding investments for more than a year, investors benefit from the longer-term capital gains tax rates, which are significantly lower than the rates for short-term gains. So this strategy encourages investors to think long-term, reducing their tax burden while benefiting from potentially greater asset appreciation over time. Also, another strategy is tax loss harvesting. So tax loss harvesting involves selling investments that have declined in value to realize capital losses. These losses can offset capital gains from other investments, which reduces your taxable income. For example, if an investor has $10,000 in capital gains from the sale of one stock and a $5,000 loss from another stock, they can net the two, resulting in a taxable gain of only $5,000. If losses exceed gains, then up to $3,000 can be deducted against ordinary income. And to avoid triggering the wash sale rule, investors must wait at least 30 days before buying the same or substantially identical securities after realizing a loss. You can also use tax-deferred accounts like an IRA or 401k, so investments held in tax-deferred accounts, such as these, are not subject to capital gains taxes when the assets are sold within the account. Taxes are only due when the funds are withdrawn in retirement. Investments in a Roth IRA grow tax-free, and qualified withdrawals are also tax-free, providing the potential to avoid both capital gains and dividend taxes altogether. You can also donate appreciated securities. So donated appreciated stocks or mutual funds directly to a qualified charity allows investors to avoid paying capital gains taxes on the appreciated value, but also receiving a charitable tax deduction for the full market value of the donation. So that's another way that you can lower the amount that you are paying in taxes on those capital gains. Also, investing in tax-efficient funds are designated to minimize taxable distributions to shareholders by keeping turnover low, avoiding frequent trading, and focusing on long-term capital gains rather than generating short-term gains and non-qualified dividends. So index funds and ETFs, these exchange-traded funds, often follow a buy-and-hold strategy, which reduces taxable events compared to actively managed funds. Also, another strategy is to utilize tax-deferred accounts for high-yield dividends. So holding high dividend-paying stocks or REITs, which often pay non-qualified dividends, in tax-deferred accounts such as IRAs or 401ks, allow investors to defer taxes on dividends until the funds are withdrawn. This shields the dividends from immediate taxation and reduces the annual tax burden. Then finally, we talk about dividend reinvestment plans, or DRIPs. DRIPs allow investors to reinvest dividends into additional shares of the company's stock, often without any brokerage fees. So while reinvesting dividends can increase long-term returns, investors are still responsible for paying taxes on dividends in the year that they are received, even if they are reinvested. So that's a good thing to keep in mind as well. All right, in summary, capital gains. So short-term capital gains, the assets held for a year or less, are taxed at ordinary income rates, while long-term capital gains, assets held for more than a year, are taxed at lower rates, such as 0, 15, or 20%. Qualified dividends are taxed at the same favorable long-term rates as capital gains, and non-qualified dividends are taxed at ordinary income tax rates. Investors can reduce taxes by holding investments for more than a year using tax loss harvesting, utilizing tax-deferred accounts like IRAs, donating appreciated securities, and investing in tax-efficient funds. All right, so now I've got a few multiple choice and open-ended questions for you. What is the tax rate for long-term capital gains for an individual in the 24% income tax bracket as of 2023? Is it 0%, 10%, 15%, or 37%? The correct answer is C. It's 15%. What type of dividend receives favorable tax treatment similar to long-term capital gains? A. Non-qualified dividends. B. Qualified dividends. C. Ordinary dividends. Or D. Reinvested dividends. In this case, it's those qualified dividends. They get that same tax-favorable treatment as long-term capital gains. What is the maximum amount of capital losses that can be deducted against ordinary income in a single tax year? Is it A, $1,500, B, $3,000, C, $5,000, or D, $10,000? So in this case, the answer is B. It's $3,000. What is the primary benefit of holding investments for more than 1 year? Is it A, capital gains will not be taxed, B, capital gains taxes are lower on long-term rates, C, dividends are taxed at normal income tax rates, or D, losses can be deducted against capital gains? The correct answer is B, capital gains are taxed at lower long-term rates. Which strategy allows investors to offset capital gains by selling investments that have decreased in value? Is it A, tax loss harvesting, B, the wash sale rule, C, dividend reinvestment, or D, indexing? The correct answer is A. That's known as tax loss harvesting. All right, now a few open-ended questions. What is the primary difference between the taxation of qualified and non-qualified dividends, and how does this affect investors' decision-making? So qualified dividends are taxed at lower long-term capital gains rates, that 0, 15, or 20%, while non-qualified dividends are taxed at ordinary tax rates. This difference encourages investors to seek qualified dividend-paying stocks or more tax-efficient income. How can tax loss harvesting benefit an investor, and what limitations should they be aware of? So tax loss harvesting allows investors to offset capital gains with capital losses, reducing their taxable income. However, investors should be aware of the wash sale rule, which disallows the deduction if the same or substantially identical security is repurchased within 30 days of the sale. And finally, why might an investor choose to hold high dividend-paying stocks in a tax-deferred account rather than a taxable account? So holding high dividend-paying stocks in a tax-deferred account, such as a traditional IRA or 401k, allows investors to defer taxes on dividends until withdrawal, potentially reducing the tax burden during their working years. All right, how did you do? If you feel good about those topics, go ahead and move on to the next lesson. If not, please review before continuing. And that's all for our lesson for today. Thank you very much for listening.